Welcome back. We've just reviewed a really insightful piece on silver, its explosive 2025 run, and the forecasts for 2026.
Mm-hmm.
It really breaks down how that industrial demand squeeze and, monetary policy drove prices, looking ahead to potentially $100 an ounce.
Yeah,
And I have to say, the use of specific targets from BOFA, UBS, Citi, that really anchors the analysis, gives it weight.
it does. That foundation is solid, no question. And identifying those two core drivers, industrial and monetary, is, well, spot on. But if we want to really push the analysis further, make it more engaging for the reader, we should probably dig into how those drivers interact, especially around risk.
Okay.
So the discussion of industrial demand, while it's right there as the key fundamental driver, could be, let's say, strengthened by linking its sheer scale to silver's main vulnerability much earlier on.
Ah, I see. So the weakness isn't the identification of the driver itself.
No, not at all. The piece clearly nails driver #1, that industrial squeeze from solar, EVs, 5G as the floor, the reason for this, what, 4-year deficit we're seeing? That's all correct. But the risk that comes with that reliance, the big one, global recession risk, well, that's tucked away much later under the what could stop the rally section.
Right. And I think I see the issue there. By separating them so much, you kind of lose the inherent tension. Like, here's the massive engine driving the price, but the brakes, we'll talk about those way later.
Exactly. It compartmentalizes it. You lose that dynamic tension. Silver is both an industrial metal and a sort of safe haven asset. Sometimes that conflict is interesting. So the suggestion is really about integration. Weave that recession threat right into the discussion of driver #1.
Hmm.
Make it clear from the start that silver's greatest strength, this industrial demand, is also potentially its Achilles heel.
Okay, I get the concept. Build attention early. The piece makes a strong case for the industrial demand being the floor, but you're saying we need to show how shaky that floor might be if the global economy takes a nosedive.
Precisely.
So how do we do that practically? When we're talking about, say, record photovoltaic demand, how do you inject that risk without muddying the main point?
Well, you could use rhetorical questions, maybe a slight counterpoint. As you describe that record demand, maybe pause and ask something like, okay, this demand is huge, but is this floor truly recession-proof? Or, does this heavy reliance mean silver's just one bad GDP report away from a demand shock?
Ah, okay. That immediately makes the reader think, adds that layer of sophistication. It acknowledges the contradiction.
Yeah, and you can make the link more explicit, too. The piece mentions the threat of a hawkish Fed later on, right?
It does.
Well, connect that dot directly back to industrial costs. Higher rates mean higher borrowing costs. That hits big capital projects first, exactly the kind of solar farms and EV plants driving silver demand.
Gotcha. So it's not just some abstract market force. It directly impacts the physical demand driver.
Right. You contrast this certainty of the current structural deficit that's happening now, physically, with the conditional nature of the really bullish forecasts. Makes the risk feel less hypothetical.
And more tied into the core story of silver's industrial boom.
Absolutely. You could even bring in that World Bank warning, the one about the rally perhaps ending in 2027 as the market balances.
Mm-hmm.
Well, explore how a recession could actually accelerate that balancing act. That makes the risk feel really present, central to the forecast, not just a footnote. It shifts the whole piece.
Okay, that's a really strong structural point. Integrating that risk narrative up front. Makes sense.
Good.
Now, let's talk about the really exciting part, the 2026 price targets. This feels like an area where structure can really amplify the impact.
Definitely. It's where market psychology really comes into play.
So to maximize that narrative impact, maybe leverage the market psychology a bit more. The structure presenting the 2026 target should probably be reorganized around the $50 all-time high. Make that the pivot point.
Okay, tell me more. Because right now, the weakness I see, or maybe just missed opportunity, is that it lists the targets very linearly. $41 World Bank, $43 Citi, $55 UBS, $65 Buffet, then the big $100 number.
Yeah, it's very sequential, almost like reading numbers off a spreadsheet.
Right. And the mechanism for those highest targets, the really explosive ones that short squeeze the FOMO, it only really kicks in if silver breaks and holds above $50. But that connection feels, Well, it's mentioned later almost like a separate idea.
It does diminish the drama, doesn't it? That $50 level isn't just another number. It's the number, the big psychological wall, thanks to 2011, even 1980.
Exactly. You nailed it. It's the historical battleground. So the suggestion is use $50 as the main narrative filter for that whole forecast section.
A filter. How would that work?
You clearly distinguish between the forecasts that assume $50 basically holds as resistance versus the ones that depend on it breaking. It forces the reader to grapple with that psychological hurdle right away.
Okay, I can see that creating more tension. But is there a risk of making it seem more complicated than a simple list? Easier to follow might be just low to high.
Easier maybe, but less impactful? I think so.
We're aiming for compelling, not just clear. The tiered approach makes the reader feel the significance of that $50 fight.
Okay, let's think about concrete examples then. How would you start that section?
You'd frame it right at the top. Call $50 the psychological and technical breaking point, or the key battleground, before you even mention $41. Set the stage.
Right, lead with the drama. Okay, and then?
Then, you present those more conservative targets, the World Bank $41, Citigroup $43, as scenarios where $50 doesn't break or acts as a ceiling. This establishes like a new baseline, a normalized floor based on those fundamentals we talked about, assuming things stay somewhat rational.
Okay, so that's stage one, the fundamental floor if $50 holds.
Exactly. Then stage two. You group the more aggressive institutional targets like UBS $55, BOFA $65. Present these as the targets that become possible after $50 is decisively taken out. It shows that even the big banks see conquering $50 as a prerequisite for those levels.
Ah, so it connects their fundamental analysis to the technical and psychological break.
Precisely. And then finally, stage three. You position that $100 hyperbull case, the Solomon Globals, the stuff you hear on CNBC sometimes, as the consequence of breaking 50.
The sort of emotional, technical follow-through.
Yes, it's not really about fundamentals at that point. It's the short squeeze, the FOMO kicking in, because that massive historical barrier has fallen. Pure market dynamics.
That reframing feels much more powerful. It creates distinct tiers of possibility, all hinged on that central $50 battle. It differentiates between fundamental targets and, momentum-driven targets.
Exactly. It turns a simple list into a narrative roadmap, much more engaging and, frankly, a more accurate reflection of how markets often behave around those major levels.
That's a significant structural improvement. Makes the whole forecast section feel more strategic, more analytical.
Yeah, I think so too. Look, overall, this is a strong piece of analysis. It's well-researched, the logic holds up, you've clearly tapped into solid institutional data. The heavy lifting on the research is done. But taking it to the next level is about that editorial structure. It's about turning solid analysis into a really gripping narrative, one that embraces the tensions and contradictions inherent in a market like silver.
Right. So just to recap the main actionable points for the author. First, integrate that global recession risk. Don't save it for the end. Weave it directly into the industrial demand story early on. Acknowledge that strength-vulnerability tension up front.
Spot on. And second, restructure those 2026 price forecasts. Ditch the linear list. Pivot everything around that crucial $50 psychological level. Create those tiers, what happens if it holds, what happens if it breaks, and what happens because it breaks.
Okay, those two changes really focus on narrative tension and structure.
They do. And honestly, the underlying analysis is strong enough to support this more sophisticated structure.
We were genuinely impressed with the depth here. So refine that structure, tighten those narrative threads.
Yeah, really lean into that tension.
And please do send it back. We'd be very interested to see how these changes elevate the piece.
Absolutely. Looking forward to the next version.